Hey, how's it going, guys? Welcome to the Module 3 of Options Trading Foundation, the complete options trading course for beginners. Module 3 is all about the spread strategies in options trading. There will be 4 sub-modules in Module 3 covering 4 extremely important spread strategies for complete beginners. In general, trading spreads is probably one of the most classic styles when it comes to options trading. They're easy to understand, easy to execute, and also can profit from all kinds of market environments if used properly. My goal for this module is to help you guys fully understand these 4 basic spread trade setups with the real examples and the case studies so that you will have the full confidence to execute all these strategies on your own. Alright, let's get started with sub-module 3.1, the bull call spread. Before we jump into the bull call spread details, let's take a look at what exactly is the spread in options trading. Spread is a common options trading strategy that involves buying an option and selling an option simultaneously on the same underlying stock. Because each option contract has a different strike price and a different expiration date, we can categorize spreads into 2 major categories. First is the horizontal spread. This is a type of spread strategy that you buy and sell options on the same stock at the same strike price but with different expiration dates. And another category is called the vertical spread. This is the type of spreads that you buy and sell options on the same stock with the same expiration date but with different strike prices. In this beginner course, we will only focus on the vertical spread, which is much more common and much more suitable for beginners. Within the vertical spread, there are also 2 major categories, and these 2 categories are extremely important for beginners to understand the differences. The first type of vertical spread is called the debit spread. The debit spread basically means that the traders would buy an option with a higher premium and at the same time sell an option with a lower premium, which will result in a deduction or a debit out of his trading account. The 2 classic examples are bull call spread and the bear put spread. The other type of vertical spread is called the credit spread. A credit spread means that the traders would buy an option with a lower premium and sell an option with a higher premium, which will result in an income or a credit into his trading account. The 2 classic examples are bull put spread and the bear call spread. Basically, we can summarize all the major option spreads into this simple chart. On the left, we have all the vertical spreads, and on the right, we have all the horizontal spread. The most common strategy under horizontal spread is called the calendar spread. This is a much more advanced strategy which I wouldn't recommend for complete beginners. In this beginner course, we will mainly focus on the debit spread and the credit spread, which is this module 3 all about. Alright, now let's move on and start with the bull call spread. So when do traders use bull call spread? In general, when you see a potential positive catalyst for a company and expect their stock will go up or outperform the major index in a certain period of time, you want to buy the call option on the company's stock, but the call option premium is overpriced due to the short-term hype over that company. Then this is the perfect time a bull call spread can help. Basically, it's similar to buying a call option. You're trying to take advantage of the potential bullish move on a certain stock, but at the same time, you want to avoid overpaying for the expensive call options. So a bull call spread will work much better than just simply buying overpriced call options in such a situation. There are 2 trade legs in a bull call spread trade setup. First, you buy one call option with a lower strike price. Second, you sell one call option on the same stock with a higher strike price. So basically what you're doing is that you are using the instant income from shorting a call option to finance your long call position. And here are some important details to notice. All the options are call options, no put options involved. Both of the strike prices should be higher than the current stock price. So which means both of the call options in your trade setup should be both out of the money. They both should also have the same expiration date. And finally, the ratio of the numbers of the calls you buy and sell in the bull call spread trade setup should be strictly 1-to-1. If the amount of calls you buy are different than the calls you sell, then it will no longer be considered a bull call spread. Alright, now let's take a look at one case study and use Twitter as an example. Twitter is currently trading at $40 per share in October 2020. Their next earnings announcement will be in 3 months' time, and you'd expect their next quarter earning result will be extremely positive. However, this stock has been always a very popular stock, and their call option premium always stays overpriced. You want to make profits from Twitter's next potential bullish move, but you do not want to risk too much on the call options premiums. Remember what we have discussed back in Module 2, your maximum potential loss of buying a call option will be the premium you pay to own that option contract. That means the less you pay for that call option, the less risk you'll be taking for that trade. So for such a situation with popular stocks like Twitter, the best way to construct your trade is to use a bull call spread. And this is how it works. First, you buy one of January 2021 call option at a $43 strike on Twitter. the premium is currently traded at $3.3 per contract. Then at the same time, you short one January 2021 call option on Twitter at a $45 strike. The strike price is slightly higher, so the premium will be slightly cheaper, currently traded at $2.9 per contract. After you execute this bull call spread trade, you will have a net debit of $40, 3.3 minus 2.9 and multiply by 100. This will be the total amount of money out of your account when you complete this trade. Your total risk will be equal to your net debit, which is $40. Your maximum reward will also be limited when you do a bull call spread trade. It is equal to the differences of the two strike prices multiplied by 100 and then minus the net debit. In this case, it will be $160. And finally, your break-even price will be your lower strike price plus your net debit divided by 100, which is $43.4 in this case. Alright, with all these numbers, now we can draw this risk graph for this bull call spread trade. This is how the P&L line looks like for this trade. First, we have the higher strike price at 45 and the lower strike price at 43. Then we have the break-even price at $43.4, which is between these two strike prices. So, if Twitter's share price moves up and stays above $43.4, your trade will be in profits. If the price breaks the $45 before the expiration date and stays above it, you will hit the maximum profits of this trade, which is $160. On the other hand, if the price stays below $43.4, your trade will be in losses. And if it stays below $43 until the expiration date, your bull call spread will hit the maximum loss, which is $40. Of course, your best case scenario for this trade would be Twitter breaks out and stays above $45 after the earning announcement so that you can cash out $160 as a maximum profit. So this is how the risk graph looks like for a bull call spread trade. Now you probably wonder, why do we choose 43 and 45 for our strike prices? How do we choose the correct strike prices for our bull call spread trade setups as a beginner? In general, as a beginner who just started out in the options trading, you want to follow these three rules when it comes to choosing the right strike prices for your bull call spreads. Rule number 1, always use out of the money call options, which means both of the strike prices should be higher than the current stock price. Rule number 2, for your higher strike, always use your 3 to 6 month price target as your higher strike price. Rule number 3, your lower strike price should be always determined by your maximum risk per trade. Maximum risk per trade is the term that traders often use when it comes to position sizing and money management. As a beginner, if you follow the three rules with a certain amount of practice, you will be able to find the best strike prices pretty quickly. Alright, now let's do a quick comparison between a bull call spread trade and a simple long call trade for the same example, and see why a bull call spread trade is a much better strategy. First, the maximum risk for the bull call spread is only $40, compared with the $330 risk when you long a call option at a $43 strike. Your maximum reward will be capped at $160, so basically you are taking $40 risk to gain $160 profits when you do a bull call spread. Your risk to reward ratio is 1 to 4. For long call trade, your maximum reward is unlimited. The cost of bull call spread is much lower compared with simply buying call options, especially when it comes to those popular stocks. This is the main reason why bull call spread works extremely well when it comes to those large cap popular companies in the major index. And finally, the bull call spread will have a much lower break-even price. This is huge because it means you will have a much higher probability to be in the profit zone when you construct a correct bull call spread trade. Cool, here's a quick summary for the bull call spread strategy. It is a bullish trade and works well in a low volatility market environment. It is a debit spread strategy, meaning you will have a certain amount of money out of your account first once you put on such trades. Your potential risk will be limited and your potential reward will also be limited. A bull call spread generally has a pretty high reward to risk ratio. It can be used to reduce the cost and the risk of a bullish trade compared to a simple long call trade. It can also be used to reduce the break-even price. All of the morning calls are preferred in the bull call spread trades. For those beginners who just started learning how to trade the bull call spreads, I highly recommend you to start with those call options with a longer than 90 days expiration period, because it can give you much more time to be right and much less premium fluctuation to manage your trade. And also, those call options with longer expirations generally have higher premiums due to the higher time value, so it can indirectly force beginners to take smaller position sizes. Alright, that will be the end of this Module 3.1, the bull call spread. In the next video, we'll move on to the Module 3.2 and show you guys another important debit spread strategy, the bear put spread. If you're new to this channel, my name is Vic. I hope you guys enjoying the course so far. If you find my contents have been valuable to you, please consider subscribing. Again, thanks so much for watching, guys, and I'll see you guys in the next one. Bye for now.